All right, back with another earnings alert. You see shares of Chipotle up almost 4% on their Q3 earnings. Earnings per share $9.51 versus $9.21. Expected revenue $2.22 billion, narrow miss from the $2.23 billion expected. Net income $257 million, up from $204 million a year earlier. Same store sales up 7.6%. Let's take a deeper dive into these Chipotle numbers. Let's bring in Morningstar equity analyst John Dunlop and Yahoo Finance's Brooke DiPalma is here with us as well. Nice to see you both. So Sean, your reaction to the numbers?
Yeah, I think broadly positive. Clocked in more or less on the money with sales, a little bit ahead of us on EPS, and it's starting to look like it may be time to call the bottom on restaurant margins. The company's been able to price through, mid-single digit to high single digit on pricing. You saw comp sales clock in at 7.6%. So even as we're starting to see a bit of a traffic return to the office, the company didn't see a massive drop off in traffic, which is encouraging. On the development side, 43 net new units, maintained guidance for the year, and it looks like 8.5% or so at the midpoint for next year. So I'd say net positive all around.
And let's take a step back. Morningstar highlighted that Chipotle was one of the best recession performers back in 08, 09. Here we're seeing shares rising in after hours trading. The CEO noting consumer discretionary spending tightening a bit. But do you think Chipotle ultimately stands as a recession-proof stock once again here?
Yeah, recession-proof might be a little bit of a misnomer, but it's certainly recession-resistant. And I think what you see is a lot of consumers that might trade out of higher-priced full-service menus will trade down into fast casual or QSR plus, which is sort of that niche that Chipotle sits in. So even though they'll have a subset of consumers that may trade towards relative value, like a QSR pizza or like a McDonald's, you've got another subset that's trading back down into the category. So net-net, they end up being a lot less sensitive than you would think at first blush.
And one thing that really drove this quarter ultimately was those higher prices. In August, they took higher pricing for the third time in 15 months. Do you see that continuing, higher prices continuing to the end of the year? And how do you see the consumer willing to put up with those higher prices at a fast casual chain like Chipotle?
Yeah, it's a great question. So I believe they took price in the middle of August, and that was the last planned price increase for the year. But you're still looking at ballpark 8 to 9% price in that fourth quarter. And as you hold that against guidance for comparable store sales, you can see that the implication is that traffic and average check combined are probably about flat. So there's sort of two levers there. One, you're seeing a return to sort of downtown urban markets, which means that you're seeing a lot more single entree orders. And that's going to pull your average check down. The good news is that means that traffic may continue to be positive in terms of total transaction count. So net-net, the consumer continues to bear it, but definitely something that we're monitoring as we move forward.
What is your reaction to digital sales, and is there any surprise to the downside in this report to you?
Yes, digital sales obviously declined a little bit on a linked quarter basis. We're down around 37% from, I believe, 39% last quarter. That's not totally unusual. About 20% of Chipotle's sale mix ties to delivery sales. It's a higher cost channel, and a lot of the time those customers trade out of the category entirely rather than down the menu. So we saw similar results with Domino's earnings a couple of weeks ago.
And also I want to highlight, when we spoke to Chipotle CEO last week, we also touched on that FAST Act, Recovery Act that's happening over in California that could impact higher wages, expansion in California. How do you think that sort of plays in after seeing these results in Chipotle's expansion plans and also on that hourly wage?
Yeah, two really good questions. So the FAST Act, you're talking about a $22 wage floor. And of our publicly traded restaurant company, Chipotle is the most exposed. One, because they own their own restaurant units. It's not really a franchise concept. And then two, because 15 to 20% of unit count sits in California. So historically, there's not really been a close tie between average wages and restaurant profitability. But the problem is that restaurants are so much more dependent on hourly labor relative to grocery stores or C-stores that we may start to see a little bit of a mix shift. That's the real issue with the FAST Act. So offsetting that a little bit on the growth narrative side, it's nice to see the success we've seen in rural areas. Hopefully the firm's able to lean into that a little bit and defray some of the explicit pressure there.
For 2023, they're projecting 255 to 285 new location openings. Back to Brooke's question, do you think paying that additional labor charge in California could hamper those expansion plans?
Yeah, we certainly haven't modeled in yet, and we haven't heard anything from restaurants themselves. But it would make sense, all else equal. You've got higher labor costs, you've got softer unit economics, that the payback periods would lengthen, and maybe it would be more appropriate to look for investments outside of that market. Really, with the FAST Act, the long-term implication for investors ties to more if that happens anywhere else, if we see that sectoral bargaining extend beyond California to maybe in Illinois or in Oregon or some of the more progressive states.
They're betting big on Chipotlanes here. We saw 43 new restaurants and 38 locations, including a Chipotlane. You highlighted in your note that those ultimately drive higher sales. Are you encouraged that most of these new units include that drive-through? And do you think that term Chipotlane is really sticking here?
Yeah, it's a good question. And I think they would shy away from using the term drive-through because they actually have certain zoning restrictions that are tied to those drive-through units that Chipotlanes try to circumvent. So it lets you put in what's tantamount to a drive-through in a lot of pads that wouldn't necessarily permit that otherwise. Basically, the thrust, 88% of net new units had a Chipotlane this quarter. The economics are better. They do about 10 to 15% more sales. You have a higher volume of digital sales, about 50 to 55%, relative to 40 to 45% for a normal unit. And then those tend to be the highest profit margin sales, those order ahead and pick up in store sales. So what's not to like, I guess, when you come right down to it, the cash and cash returns are about 60 to 65%, meaning you get your money out of those in less than 2 years.
Still never seen a Chipotlane myself, Brooke.
Yeah,
I don't know about Sean. I go to there all the time. Never seen it. Sean, I know you got to jump to the call, but what do you want to hear on this call coming up?
Yeah, I'd like to hear them reiterate that commitment to unit growth for the longer term. They've got that 8% to 10% annual target. And then I'd also like a little bit more color about what drove sort of the flat price mix and traffic, because if it is traffic, then you start to see a little bit of concern with consumer trade down.
Indeed, good stuff. Sean Dunlop, appreciate you being here. Brooke DiPalma as well. Thank you both.